There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery is on the floor today for the New York Stock Exchange. He'll be along in a moment to give us some details on the action in today's session. I'm going to start with the major averages here. The Dow, when all was said and done, finishing down by 817 points. That's a drop of 1.9%. The S&P 500 down by 1.6%. And the NASDAQ down by 1.4%. Now, as we've been talking about throughout the day, the real point of focus for investors today was at 1 p.m. And that's when there was the result of an auction of 20-year treasuries. Now, that auction drew less demand than had been anticipated, resulting in a higher yield on that. This really gets to the core of what investors recently have been concerned about. Is there less demand and appetite for U.S. assets? It's just one auction. But nonetheless, with the sort of jitters in the market around that issue, we saw stocks across the board take a leg lower at that point in time and finish pretty much at the lows of the session. Jared's got a closer look at the action today. Hey, Jared.
Thank you, Julie. It's like I was talking with Josh yesterday after the bell. Everyone's going to become an expert on bond auctions so we can figure out what equities are doing. And today we got that downdraft. Let me just skip right down to the 30-year, and then I'll get into some heat maps. Here's a 30-year yield, and this is in Central Time, by the way, so you notice this is afternoon, but it's 1 p.m. Eastern. That's where the auction took place here in New York. Less demand than expected for the 20-year. The 30-year shoots up to 5.09%, and that is the highest in quite a long time. And let's get straight to some of the sector action today because it was pretty negative. The day did not start out well, and it's ending a little bit worse. Tech was the leader before the market, but you'll notice a lot of other sectors ended the day a bit lower. Real estate down 2.5%, healthcare a little bit less, financials and consumer discretionary down 2% each. The best of the group were actually the two consumer staples and communication services down the least. And if you take a look at the NASDAQ 100, you can really see some of the damage done. Not a whole lot, not seeing a lot of dark red. You do see PanW, that's an earnings story from yesterday, Palo Alto, Palantir down 4%. But Google, Alphabet stands out right in the middle there, up 3% or so. And not a lot of other green on the screen. Netflix up just barely, Mercado Libre up about 0.9%. And if we take a peek at the Dow here, very similar story. Only Coca-Cola in the green. We got 3M trading to the downside, down 3%. United Health down 6%. Nike down 4%, along with some of the other big ones. And transportation stocks, which were playing a game of catch-up recently, those are now underperforming, and we can see a lot of dark red. Uber, the biggest in the transports, down 3.5%. It's been hitting record highs recently, not today. United Airlines also down 4%, and Delta down 3.5%. Back to you guys.
Thank you, Jared. Well, for more on today's market action, let's welcome in here Amy Kong. She is a partner at Corient. Corient has currently more than $177 billion in assets under management. Amy, always good to see you.
Thanks, Josh.
So maybe start with just helping us walk through and understand what we saw in the markets today, because we had stocks sliding, I had a weak treasury auction, the dollar dips. What do you make of it? How do you explain it?
Yeah, absolutely. So, the market is obviously really feeling the aftershocks of the Moody's downgrade. And you're starting, as Jared noted, the yields on the 10-year, 20-year, and 30-year bonds starting to move higher. The 10-year has now edged above 4.5%, which, psychologically, that's some sort of milestone that investors have in their minds. When the interest rates have gotten to this level, I think investors start to worry a little bit about what that ramification would look like for the equity markets, what that means for liquidity, for credit, and so forth. And so that partly explains why the market is starting to sell off. Of course, you've also had this sort of a relief rally from the lows of April, if you would. And so take a little bit of a breather based on some earnings miss, you name it. It's certainly not a surprise for me.
I wonder also if this raises the pressure on the Federal Reserve to cut rates. And, will equity markets start sort of looking to that as a potential catalyst?
It's certainly in the back burner. I don't necessarily think the Fed's going to react based on this. Of course, they are watching it. I think the Fed, as we all know, it has a dual mandate, and certainly they are very keen on the inflation part. I think they'll start to focus a little bit more on the full employment part, and if we start to see data points suggesting that the market is softening or the economy is softening, and that, again, jobs are not being added as much as they had been in the past, that might trigger the Fed to potentially, start to make a move. But for now, the Fed has communicated that they are wait and see, if you would, and that, when you think about Fed futures, et cetera, we're expecting about 2 rate cuts towards the back half of this year.
Amy, we've had some bullish strategists and portfolio managers on recently, and they kind of always say that they say keep it simple, basically. I mean, to them, I'd love to get your take on this. They say, listen, I cut through all the headlines and I just say earnings have been solid and employment solid and the economy's running like 2.4%,
Sure.
according to the Atlanta Fed tracker. And to them, and this is their words, they say, I just see more in this market to like than fear, and I'm just wondering how you respond to that case.
Sure. I can see the validity to that, right? I'm a long-term investor myself, and so a lot of what we've been seeing in the headlines all the way from April 2nd and even in the earlier parts of this year, a lot of that is noise. And as a long-term investor, we want to cut through the noise versus fundamentals. So certainly I agree with some of the points you've made in the sense that at the end of the day, it is what earnings that should be one of the key drivers to stock market returns in the long run. However, in the short run, we don't want to dismiss that tariffs and some of these other pressure points could impact how CEOs think through earnings and think through how profitability can be sustained. And so in the short run, we certainly don't want to discount that. But I do think that certainly finding companies that have the ability to manage through tariffs, the ability to manage through some of these potentially higher costs, as a tariff it is a tax, I think ultimately that will pave the way to earnings likely to still grow. Of course, it's not going to be a straight line, it'll be a bumpy, but we do think that earnings growth, at this rate is still looking at about 10, maybe 11% between this year and next year. That still could be a foundation for hopefully some positive returns for the stock market.
So then strategically, would you say you're getting more defensive, or you are indeed looking sort of case by case at the companies that seem to be navigating tariffs better?
Yeah, I think in the long run, we, again, did not react to the panic that we saw in April. I think that, in hindsight has been a good call. We are now getting this rally, if you would, since the April lows, and this is probably another good window for clients and investors to think about whether diversification away from stocks into some bonds or just to, again, rebalance where appropriate makes sense. Within the stock component, to your point, we certainly want to be in companies that can maneuver through this storm in a better fashion. We also don't want to discount the fact that the economy is slowing. And so we want to make sure that we have companies or exposures to areas of the market that, again, can benefit if this moderation continues.
Final question, let's talk politics, Amy, because Trump's tax bill front and center was making a lot of headlines today. How often are your clients asking you about that?
I think they're very keen on that. Certainly there are some estate tax laws that are embedded in some of those proposals. I think at the end of the day, they're not really asking as much about that. I think they're very concerned about what the state of the economy could look like with the tariffs, with some of these new policies in place. And as we've been, and as I've been telling clients, at the end of the day, when you really zoom out and think about the stock market and its returns, whether it's a Democratic or Republican, administration, that doesn't play as much of a role when you think about long-term performance. And so ultimately, we want to guide clients, again, through the noise and really stick to fundamentals, again, companies that can really, again, manage through these types of headwinds over the long run.
Amy, always good to see you, especially on set. Thanks for joining us.
Thank you so much.
All right, let's get to some earnings here because Snowflake reporting first quarter earnings results, and those are just crossing the wires. Let's get you those numbers. Snowflake reports Q1 adjusted diluted EPS 24 cents. She was at 21 cents, so that is a beat. Revenue 1.04 billion. She was at 1.01 billion, so that is a beat as well. Let's turn ahead in terms of what they see for the second quarter. It looks like they are looking for product revenue 1.04 billion to and the street was at 1.03 billion. They still see, and I think this is why you're seeing the stock doing what's doing here in the after hours. They see full year product revenue. They're calling for 4.33 billion. They had seen 4.28 billion, and the street was at 4.29 billion, and we have the stock up nearly 7% in the after hours.
Yeah, and just to put some more details on that, revenue was a 26% gain in revenue year over year. The company is giving a little bit of detail as to what their customers are like in terms of size. They say they have 606 customers with trailing 12-month product revenue of more than $1 million. They have 754 Forbes Global 2000 customers. So in other words, a pretty high number of large companies that are their customers here. So they're sort of emphasizing that. They have 11,000 customers overall, according to Sridhar Ramaswamy, who is the CEO of the company. And so, sort of relying on those large enterprises for the growth that the company is seeing.
Yeah, lots of questions for this one. Not just about the print, but obviously broader questions are going to come up in the call. How do executives think about the macro, about any potential downstream tariff impact, the competitive landscape? How could that be evolving and Snowflake's place in it? So lots of questions. We have just the person to ask, though.
We do.
Ahead of that call.
Let's talk about it. For more on Snowflake and the software sector more broadly, let's get to Pat Walravens, Head of Technology Equity Research at Citizens. Pat, thank you so much for joining us. First of all, just sort of give us your high-level reaction to these Snowflake numbers that at first blush seem pretty strong.
It looks great, right? So good for Snowflake. The last quarter they grew 28%, and this quarter I think it worked out to 26. So people were expecting it to go down to 22. They're growing faster than people had expected, and it suggests that for this company at least, the macro hasn't impacted them too badly, and we can certainly talk about why.
So fill that in for us, Patrick. How come?
Yeah. So I think, look, every company right now is talking about agents, right? And the key insight that we learned this quarter as we were doing all of our work talking to industry experts is that if you want an agent to do its job, it needs data. And that data in a lot of companies resides inside of Snowflake. So as companies all over the economy are trying to figure out how do we have these AI agents do, how do I get a late checkout at Marriott? Would be one example. Why can't that be done by an agent? Well, that agent then has to go into some data source and find out, what is Mr. Walraven's status? Who is coming to this room next, right? What time is the next person coming to the room? So that all the focus on AI and agents is driving the need for the data that Snowflake provides.
Yeah, and from personal experience, you still need a human to do most of that stuff. The AI or just the automated agents is not quite yet up to the task, at least not in my experience. But so how is Snowflake then stacking up to competitors who are attempting to do the same thing? So who should we think of as sort of leading in this area besides a Snowflake?
The two dominant companies in this space are Snowflake and a San Francisco company that your viewers, I'm sure, are quite familiar with, that's private, called Databricks, right? And Databricks is about $3 billion in revenue. They disclosed that in the October quarter, they grew 60%, and they were last valued at like $62 billion. Snowflake, by comparison, is $4.5 billion in revenue, just grew in the high 20s and is valued a little higher than that. But these two are neck and neck. Snowflake is a little better on the data warehouse side and having a really easy to use solution. And Databricks is a little better on the AI and data science side. And so those are the two big players in the space. They're both having user conferences in San Francisco in June, one right after the other one.
Patrick, kind of a broader question I had for you about a lot of the names that you cover. When you look at the software earnings, Patrick, that we've gotten, I think you would say, generally solid, generally better than feared. I know a question on the street, though, Patrick, is whether we're kind of kicking the can down the road. And there is going to be macro weakness, and it is going to hit these names in the quarters ahead. And I'm just curious how you're trying to think through that.
Yeah, so far so good. So of the 25 or so software companies that we already had report, I think, 13 of them, I think, are trading up from where they reported and 12 down in our universe. So that's definitely better than was feared. The wrinkle on all this is that most of the companies that have reported so far have been March quarter ends, and Liberation Day was early April. So investors have been really waiting, sort of bated breath here to figure out what would a April quarter end company look like. And, we just got that from Snowflake, and it looks pretty good. So fingers crossed that people are still investing in software because, of this huge focus on AI, right? And that it's helping offset those macro headwinds. The big one that's coming up, of course, is next week we'll see Salesforce, and we'll see how they did.
And I want to get to that, Patrick, but one kind of just broader question. Do you think in Q1, when you looked over the names that you cover in this software space, Patrick, do you think a lot of these names, were they benefiting from pull forward?
So I think that is true when you have companies that have some sort of a hardware component or have something that they need to import and they wanted to get ahead of the tariffs. I really don't think it's as true for software, right? Because, it's sort of a bizarre thing, but software is not subject to tariffs. So I don't think that was the driver. I understand that's part of the investor thinking out there.
Pat, I do want to turn to Salesforce because we're going to hear from them next week. And I'm curious how you see them sort of stacking up in this environment that you've been talking about.
Yeah. So big picture, first of all, Snowflake just grew right in the high 20s. Salesforce is kind of moving along at like 9% growth. So that is, way below what historically we've thought of this business is doing. And they have a really tricky transition in front of them right now, which is they are trying to shift from selling seats of, Salesforce automation software or call center software to selling a product they call Agentforce, which is exactly what it sounds like. It's selling AI agents, and those are priced on consumption. And in fact, Salesforce just changed the pricing last week. So there's Salesforce is heading in the right direction. They're trying to work through a big transition, and we'll see how that all plays out when they report.
And Pat, I mean, it's just interesting. You look at Salesforce, look at Benioff's company, the stock. I mean, we're down about 20% this year. We're basically flat over the past 12 months. Are there catalysts that we could look to, Pat, that may get this stock working again?
Yeah, and so the big catalyst will be the customers who buy Agentforce actually starting to deploy it at scale. So far, they've gotten like 5,000 customers to start using it. The issue is that, as Julie was talking about just a minute ago, it's tricky to get these things to work in a way that make your customers happy. So companies are rolling them out slowly and making sure that they really get the results they want. And since they're consumption based, if you roll it out slowly, that means the revenue that comes from it is slow. And so I think that's been slower than Mark Benioff had hoped. But look, he's been running this business now for 25 years. He has a real gift for finding, the next place to move the company to and where the demand is. And what I hear is that he's very engaged right now. So I think they're headed the right direction. I think they'll make it work. It is a little tricky at the moment. It's a little choppy at the moment.
Yeah, Pat, and I want to zero in on the timing issue of this, right? That, it's hard to figure out where we are in this sort of agentic AI adoption cycle. And it keeps sort of changing, to your point, as companies are trying to figure out how to deploy. So where are we right now? What do we know about where we are in that adoption cycle?
It's so hard, right? And I've been doing this a long time. I've never seen things change this quickly. The best analogy that I could come up with is I went back and I said, if you look at the top 20 software companies in 1999, right? So before companies moved to the cloud. So on-premise versus the cloud, what percentage of those companies that still exist today in a meaningful way? So the number one company in 1999 was Microsoft, still the number one company today. But 60% of those companies are gone. Does anyone remember a company called DEA Systems? Does anyone remember a company called Sun Microsystems, right? Those were top 10 software companies. So there's a lot of change, big companies got to adapt and get through it. Your big players, Microsoft, ServiceNow, Salesforce, they're all trying to figure out how do we make sure that we're the ones who make it through this transition and come out on the other end.
I'm old enough to remember those names, but I certainly haven't thought about them in a long time, Pat.
I know.
Thanks for that trip down memory lane, and thanks so much for joining us today. I appreciate it.
That's my pleasure. Thanks for having me.
Coming up, Zoom shares are higher following their latest results as well. We'll get you those numbers, plus tell you everything you need to know to kickstart your Thursday. Stick around. More market domination overtime coming up. Zoom Communications out with its latest earnings. Shares are rising in the company here as we saw most of their metrics come out and beat analyst estimates. So the company said in the first quarter revenue was up about 2.9%, so not huge growth. It matched estimates. Adjusted earnings per share beating at $1.43 versus the estimate of $1.31. And the company's forecasts also coming out ahead of estimates, particularly second quarter forecast of adjusted earnings per share of at least $1.36. Analysts have been looking for 2 pennies less. And for the full year, it is raising its forecast for earnings per share. So we are seeing those shares move up by about 1.7%.
Yeah, and the CEO sounding a confident tone here, just reading the statement, talks about a solid quarter, talks about exceeding guidance in both revenue and profitability, says in this uncertain macroeconomic environment, customers are turning to Zoom, he says, drive efficiency, improve customer and employee experiences, future-proof their business. It was also interesting, Google at its developer conference talked about Google Beam, which is 3D video conferencing, and talked about how they're working with partners, including Zoom, to bring Beam into the enterprise. So we'll see if that comes up on the call.
You know, I know it's old news, but looking at that, I love looking at the max chart of Zoom, right? Because in the pandemic in 2020, October 2020, the high on this stock, $559.
Remarkable.
And it's now trading at just under $84. I mean, it's just, I mean, it's a solid business. It can, you know, sort of slow and steady business at this point, but it is just amazing to think about that trajectory.
Yeah, next you're going to show me a Peloton stock. Bring them all back.
Oof.
Yeah, man. All right. Time now for what to watch. Thursday, May 22nd. Starting off on the earnings front, we're going to be hearing from more retailers tomorrow, including Williams-Sonoma, Ralph Lauren, and Ross. Williams-Sonoma announcing results for the first quarter in the morning. Analysts expecting sales for Q1 to be slightly better than last year, driven by a pull forward in spending ahead of proposed tariffs. Investors will listen closely for any commentary on the second half of the year, with the tariffs in a 90-day holding pattern and weakening consumer demand.
Moving over to housing, we'll be getting fresh housing data with existing home sales coming out in the morning. Economists forecast sales will tick up to an annualized rate of 4.1 million, signaling a little more buyer activity in the housing market despite elevated mortgage rates and affordability pressures.
And taking a look at the Fed, some more Fed commentary coming our way in the afternoon from New York Fed President John Williams. This is coming after comments yesterday from Fed President Alberto Mussolem saying that the Fed's current interest rate policy is appropriate as long as trade tensions continue to ease.
And finally, Wall Street watching for the Hinge Health IPO. The company should start trading tomorrow using the ticker HNGE. So we'll see how that works out. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of break, it's asking for a trend. I've got you covered for the next half hour with the latest, greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.